Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 43 on January 5th of 2019. I'm your host, Eric, and let me just start off by saying Happy New Year. Welcome to 2019. I'm trying to say that as often as I can just to get used to it because I'm sure I'm going to be writing 2018 for the next couple months, but it is 2019, and in this week's show, we will cover the trades from last week on Mattel, United States Steel, and Halliburton, and this week we will discuss three new trades on General Electric, the USO, US Oil Fund ETF, and Apple Computers. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can send questions to eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. Or you can always fill out our contact form on the website, theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll really need to understand in order to follow along with me on the show. You can visit our website and click on the videos tab to watch it, or you can find the videos on the YouTube channel for the Weekly Option. Now, between political uncertainty in the U.S. and some questions around the strength of the global economy, several analysts are already predicting a volatile year in the equity markets for 2019. We've already seen that with price movements just this week. The U.S. started off the year with the worst opening day since 2000, which, was also the year that the tech bubble burst. But we obviously had a strong couple days in the market. We've started off 2019 with a positive move, so we ended the week positive for the week. The Dow Jones Industrial Average rose 370 points to finish the week at 23,433 points, and the S&P 500 index gained 46 points on the week, ending at 2,531 points. Now, there are 41 publicly traded companies in the U.S. that will be announcing quarterly earnings this week. The main companies I will listen for are on Wednesday. We'll have Delta Airlines, Bed Bath & Beyond, Constellation Brands, and then KB Home, all announcing quarterly results on Wednesday. And each of those are important for various reasons. Specifically, KB Home will start to give us an indication of what's happening in the market for new home sales, which is always a bit of an indicator of how our economy is doing, how strong our economy is. Now, we're going to discuss the topic of the week. And this week, I wanted to discuss leaps, using leaps as a replacement for expensive stocks. So what is a leap? Well, the acronym stands for Long-Term Equity Anticipation Security. It's typically, a leap is considered an option that is long dated, typically 6 months or further out, sometimes a year, and in some names even further than that. Some of the big indices like the S&P 500 will allow you to trade options that go 2-3 years out. So, but for the most part, most stocks actively price options that are 6 months in the future. Now, when you trade a leap, what happens if stock goes up? Well, if I own a long-dated call option and stock goes up, I actually get the improvement. I'll benefit from the move of the stock in my option. And what happens if it goes down? Well, if stock prices go down, I'm going to also see the result of that in my long-dated option. Now, a portion of the value of that long-dated option is in the time value, obviously, because you have a long time to see the stock go up or down. But at the same time, because you still are owning a option that will benefit, and specifically I'm talking about call options, that will benefit when the stock moves in your direction, when the stock goes up, you still are going to see some of the appreciation. And if you are buying, for instance, an in the money option, it really is going to move right alongside the movement in the stock. So one example I like to use, you can use leap options as a better way to manage capital when you want to participate in some of the stocks, like specifically some of the tech stocks that are really expensive, like Google or Netflix per se. So as an example, let's look at the cash outlay if you wanted to participate in Netflix. And Netflix has had a great week because they released this show called Bird Box. I think I'm the last person in the United States that hasn't seen this. I believe it's a movie. I've certainly seen lots of the images and memes around with people, Sandra Bullock, I believe it is, walking around with her family blindfolded. So I don't know what it's all about, but I do know that the stock has gotten a nice push over the last week or so. I think last weekend they announced that 45 million accounts had watched the show, and I mean it was an amazing hit, right? So if you look at Netflix stock, it closed on Friday at $297.57. So if I were to buy 100 shares of stock, that's $29,757 for one lot of stock, 100 lot of shares. I'm looking right now at the June 290 strike, and that call option right now is trading for $43.10. It's in the money, right, by $7.57. So looking at that call option, if I were to buy that June 290 strike call option, the option would cost me $4,310. And that's to also control 100 shares. So I can spend $29,000 or I can spend $4,300. So for the same amount of cash outlay to control 100 shares of stock, I can actually control just shy of 700 shares of stock equivalent in options. And why do I say that? Well, if I were to buy 7 of those options, right? So we'll just do the math. Each option we know controls 100 shares of stock. If I bought 7 of those in the money options, the June 290 strike option, that's going to be just about $30,000. So that's too much. But if I spent $25,860, I can control 600 shares of stock, or 6 options basically. That's 6 times the amount of leverage that I would get on any positive stock move versus actually buying 100 shares of Netflix stock. There's some other factors there because of the leverage as well, but the truth of the matter is, even if the stock goes down, then I still will have time to buy in that call option, right? It's not going to go from $43 to $1 overnight. There's so much time left that I can still benefit from the stock movements and still have enough time to be able to hedge against any movements against me. So how might this be used otherwise? Sure, you can obviously lever up by buying multiple options like the example I just mentioned. Another way you could think about leaps is actually in the covered call strategy. I've mentioned in the past that I don't like covered call strategies because there's no way for us to truly hedge the movement in that underlying stock. But one of the things that we can do is actually, rather than buying the stock, we can buy a further out call option. And what you do is if you buy then an in-the-money call option against the call option that you're selling in the front month, well, now you've created a scenario where, because we're dealing with American options, which don't have to do with geography, they just have to do with when you can exercise and turn that option into stock. By buying an in-the-money option, you actually are able to exercise that option immediately if you like and turn it into stock equivalent. So you own the option in a further out month, and you actually sell the option in the front month. So you can create the same risk return scenario without fear of that actual stock value dropping significantly. The dollar loss that you feel when stock moves down will be less because you're dealing with an in the money option that has so much time left that you still will have time. There's still a time value to it. So you're going to be cushioned. And that option is only going to have a certain percentage of the stock move itself. So when the stock moves against you in that covered call strategy, the option that you own further out is going to devalue less than the actual stock will go lower. And so you're actually able to minimize the risk. And that actually means that the option that you sell in the front month is going to provide a more of a good cushion against a stock move against you. There are benefits to actually understanding this, and I only sort of touched on some of the benefits of using long-dated options. Obviously, these are two specific situations where they benefit you in being able to participate in expensive stocks that you might not want to use all of your capital to benefit from, or in the covered call strategy as a means of not having to actually purchase or own the stock. You can own an in-the-money long-dated call option instead, or even a call option that has a similar strike. So there are a lot of things that you can do with option information, and one of the goals of this podcast is really on a weekly basis to share with you how I think about option trading. And I'm just one example out there. There's so many different professionals out there that all have their different views on option trading. At the end of the day, if you understand options, man, it gives you such a leg up in your portfolio versus just trying to buy shares of stock and hope that it goes up. With options, I can find ways to benefit from markets going up, down, or sideways. So I will always be an advocate for individuals not only listening and learning from people like me, but actually understanding themselves. So I challenge you every week, just, follow along with me. Write down the stock and the options that I mentioned and see what happens. I welcome you to follow along. You can check my math. It's okay. If I do something wrong, email me. Like, I am not perfect by any means. But at the same time, I think you'll find that as week after week, as you get to understand this stuff, you'll find some trades that you want to, participate in your own portfolio, and it's only going to make you stronger. So, and also, we're about to close off that holiday deal for the Option Studio, but for those of you that want to start off 2019 with a better understanding of options, definitely check out theoptionstudio.com. Now let's get into the trades for last week. We know that the market was up last week, so any trades that had us owning calls, owning stock, or selling puts made money, and any trades that had us selling calls or call spreads, buying put spreads or puts, obviously will lose money. So we'll start off with the covered call. We looked at Mattel Inc., symbol MAT, Michael Apple Thomas. The stock at the time was $9.94. We looked at selling that January 10 call at 50 cents and trying to create a 5.63% return in 3 weeks. Now, Mattel stock rose 47 cents this week, so it ended the week at $10.41 per share. This means that the January 10 call option we sold is in the money, and that's our goal with a shorter-term covered call strategy. I like to find opportunities where a small increase in the stock will yield an above-average return for a few weeks of risk. In this case, it's a 5.6% return in just a few weeks. As I stated on the last episode, this trade was purely theoretical because last week when I looked at the moves in the market, I honestly could not bring myself to suggest that anyone purchase new shares of stock. Now, thankfully, we had a strong week in the market, but at the end of the day, it was a turbulent and volatile end of the month, and this is not a trade that I actually participated in. We did look at a credit spread on United Steel Company, symbol X as in X-ray. The stock at the time was trading for $18.25. And I looked at selling the January 18.5 19 call spread for 15 cents, which creates a maximum loss scenario of 35 cents. U.S. Steel stock rose $2.09 per share, ending the week at $20.34 per share. The out-of-the-money call spread, which we sold, is now in the money, and we know that the maximum value of this spread is 50 cents. So if you tried to buy the spread back right now with 2 weeks left in this option, it would cost you around 47 cents. So that's a nearly complete loss in the matter of a week. So now I have to find a trade to mitigate some of the loss. You can look at selling out of the money puts and put spreads. Right now, I'm expecting a loss, 35 cents. Like I said, we collected 15 cents, but this spread is going to end up valued at 50 cents. So we're losing 35 cents. So anything that lowers that amount is desired. Now, however, you definitely want to avoid scenarios that will double your loss. So let's say right now I sold the 2019 half put spread against this call spread. Even though that put spread is out of the money, if stock finished between $19 and $19.50 per share, I would lose on both the original call spread and on the put spread that I would look at selling. So that would create a scenario where your risk actually changes significantly. So if you have sufficient capital and risk tolerance, you could look at selling 2 of the 18 half puts for 28 cents. And that would actually allow you to collect 56 cents in premium. So all in, you would lock in a 21-cent profit this month, from this trade. So you would start off with that call spread going against you, but by selling these 2, out of the money puts, you actually create a scenario where you turn a loss into a positive for the month. I figured that out by adding in, if you add in the 15 cents that you receive from the call spread, if you add that to the 56 cents that you receive from selling these puts, and then subtract the 50 cents that you're losing from this call spread right now, all in, you'll make 21 cents on the trade. If there was significantly more time, I would not make this trade. But right now, there's only 2 weeks left, and I'm okay with selling 2 naked puts. Now, it's going to tie up capital in your account for 2 weeks. If I do this, it'll tie up some capital, because when you sell puts, most brokerage accounts require you to have the amount of money that you would need in case this stock goes all the way down to nothing. So that means that selling the 18 half put right now, 18 half, so that's $18.50. We're talking about 100 shares, so that's tying up $1,850 per put in case it goes to zero. So times 2, you're looking at tying up $3,900, but you're going to for tying that up for 2 weeks, you're actually going to be able to create a scenario where you could possibly profit. And if stock does come on down, then what you'll end up doing is looking at closing out that risk. So the real question is, do you believe that the market will stay above $18.50 over the next 2 weeks? I don't mind that risk at all as a professional trader, but this trade might be too risky. And if you want to understand that better, feel free to email me at eric@theweeklyoption.com. Again, this show is meant for education. I try to walk you guys through what I'm doing or the way I'm looking at the markets. But by no means am I telling you to go out and do this, because you have to look at the capital in your account, and you have to look at the amount of risk that you're able to take on. If you've got a $100,000 account, losing $3,900 might not be anything to you. If you have a $5,000 account, $3,900 might be enough to take you out of the game. Always just listen along, follow along with me, do the math with me if you like, so that you can learn. But don't necessarily follow in these trades, because a weekly loss like what I just took on with this spread might actually cause you real loss in your mental and financial state. Whereas for me, this is just another trade. I always make sure that I have enough additional capital to make more trades if need be. Now, the debit spread last week, We looked at Halliburton, symbol HAL, Howard Apple Larry. The stock was trading for $26.46. And I looked at buying the January 27-26 half put spread for 31 cents. And that creates a maximum gain scenario of 19 cents or 61% return in 3 weeks. Well, Halliburton stock rose $1.96 this week, closing at $28.42 per share. The in-the-money put spread, which we bought, is now out of the money. So you can close the trade right now for 7 cents, which locks in a loss of 24 cents. Now, because there are only 2 weeks left in January, again, I'm open to considering a couple more short-term trades to make our 24 cents back, or at least a good chunk of it. So against this put spread, you could actually sell the 29.5 30 call spread and the 27.5 27 put spread for 11 cents each. That would bring in 22 cents a premium, so that would nearly offset the 24 cents loss that you took on the put spread that we would be closing. And of course, that doesn't count commissions. But it does widen out your profit zone. So both spreads are roughly $1 out of the money, and only one of them could possibly finish in the money, if anything. Now, our hope would be that the stock dies in the middle, which is where it is right now. It would die somewhere between 27.5 and 29.5 in the stock. So, which is right where we are now with 28.50 or 28.42 per share in the stock. So this strategy is actually known as an iron condor, and it's one of the strategies I will use in my own portfolio quite a bit this year. We have 2 weeks left on this trade, and if you understand options, there are a few more possibilities to offset the loss of my original trade. So you really just have to look at what the option market, the pricing is giving you, and decide which strategy, because the iron condor is only one of the options, decide which one best suits you and your portfolio. So that's it. Let's dive into the trades for this week, the first set of trades. I dig through quite a few equity market options each week, equities that are pricing options. A lot of times, though, I actually prefer trading in my own account. I prefer trading ETFs. Individual equities give you a lot of possible risk scenarios with regards to changes in management team, announcements by the management team. Those sorts of things tend to get muted when you're dealing with the larger indexes or just individual ETFs. So that being said, let's dive in. I'm looking at a covered call this week on General Electric, symbol GE, George Edward. The stock ended the week for $8.23 per share. And I'm looking at selling against that stock the January 8.5 call option, collecting 22 cents per option on that. And if that ends up in the money, that creates a 5.95% or nearly 6% return in 2 weeks. January expiration is in 2 weeks. So you would enter this trade by buying GE stock for $8.23 and then selling that January 8.5 call option at 22 cents per option. We're obviously hoping that stock rises above $8.50 so that we achieve our 6% return in 2 weeks. Our next trade is a credit spread, and I'm looking at United States Oil Fund ETF, symbol USO, Uncle Sam Oscar. The ETF finished the week at $10.18, and I'm looking at selling the January 10 9.5 put spread at 15 cents, which creates a maximum loss scenario of 35 cents over the next 2 weeks. Now, you would enter this trade by selling the Jan 10 put at 31 cents and buying the January 9.5 put for 16 cents. This is a credit spread because we are selling the spread. And this trade makes the most money if stock prices stay above $10 per share for the ETF. And one of the reasons I like this is we've seen crude oil push a little bit higher. Many traders are hoping this is actually a sort of a near-term bounce in the underlying WTI crude oil. And Again, this is a 2-week trade, so do I think crude oil will go up for the rest of the year? Not necessarily, but I think there's enough strength in the futures right now to justify this as a near-term bottom and possibly give us a little bit of positive outlook over the next couple weeks. So then the final trade of the week is going to be a debit spread on Apple, symbol AAPL, Adam, Paul, Larry. The stock ended the week for $148.26 per share, and I'm looking at buying the January 152.5 150 put spread, paying $1.45 per spread, and that creates a maximum gain of $1.05 because this is a $2.50 wide spread, and that equates to a 72% return in 2 weeks. Now you would enter this trade by buying the January 152 half put for $6.10 and selling the January 150 put for $4.65. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices in Apple stay below $150 per share. Again, same scenario as last time. This is a 2-week trade, and Apple released a little bit of guidance on their earnings, their stock earnings this past week, and shares fell 7% in 1 day. So looking at the stock chart, you'll see a series of lower lows. There have been some intermittent short-term increases in Apple stock price, but by and large, it's continued to fall. And I think this guidance is only going to give investors further reason to see it fall a little bit lower. Even though I think Warren Buffett owns some shares in Berkshire Hathaway, they own some shares of Apple. So I don't think Apple will go down all year. However, over the next 2 weeks, I feel comfortable buying a put spread in Apple. So we'll see how these trades perform in next week's show. Thanks as always for listening, and feel free to go back and you can listen to some of the previous episodes as well. You can do that on iTunes or on Stitcher or anywhere else you find this podcast, and you always are free to hop over to our website, theweeklyoption.com, where we link directly to the podcast. So feel free to join us in this journey every week. Again, Happy New Year to you. Looking forward to some prosperous trades in 2019. Happy trading. Take care. Bye-bye. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.